Uh, Caffeinated Conversations this month is sponsored by Bank of America, and we have Kathleen Ferguson here to give a welcome and some greetings from Bank of America. Kathleen, it's your turn.
Hey, good morning. I'm Kathleen Ferguson, your Business Banking Relationship Manager at Bank of America. We understand small businesses are the backbone of our communities, and that is why we're so proud to partner with AikenChamber of Commerce to present Caffeinated Conversations. You know, we need so much now during this virtual environment, and again, I'm so proud that we could be here today with Cherry Becker to offer some insights around tax planning and things that you need to know to help your business. And so thank you again, AikenChamber and Cherry Becker, and we're so proud that we're here today with you.
Well, thank you, Kathleen. We really appreciate the support y'all provide us, and we look forward to moving on to 2021, maybe with some of the stuff behind us. Let's see, something's going on. Diane, you signed on my account. I'll let now. So here, now we're at the topic. Let's go on to the topic. I think it's the time of the year that we're all thinking about the year-end taxes, 2020 year-end taxes, and planning for business. And the topic today is actually 2020 year-end taxes, planning for business for better or for worse. And I hope that everyone that's listening has a better outcome. Cherry Becker, we have two great speakers from Cherry Becker, Cindy Mears and Stephen Gaskell. I've known each of them for quite a long time, and they are very prepared to walk through a lot of the details of things that we should be ready for as we get ready for year end. So I'm going to turn it over to Cindy and ask each of them as they speak to give some self-introductions and then move forward with their presentation. Good morning.
Good morning. Pleasure to be here. Hopefully I just shared my screen. Hopefully everybody can see that. If you can't, certainly please let me know. But excited to be here. Thank you, David, Jim, for reaching out to both of us to give us an opportunity to speak about something that we have been dealing with a lot this year. 2020 has certainly been a year to remember with everything that is going on. So appreciate everybody else joining today with their interest in the topic. Certainly, hopefully we can provide some clarity around some of the things that have been passed as part of the CARES Act, the Secure Act, and some other things that can hopefully make you aware of when you're looking at year-end planning for your business. I've been with the firm for 14 years. I'm a local product. I'm born and raised in the area, graduated from USC Aiken back in 2006, and graduated from USC Aiken. So really enjoyed that and have been with the firm ever since. So I did an internship out of college when I graduated and have been here ever since. So a little bit about Cherry Becker. We are a regional firm. We have offices as far north as Washington, D.C., as far south as Miami, and we've even branched out into Austin, Texas, and kind of a little bit in between with Atlanta, Nashville, some other markets in the Carolinas. We've been in business for 70 years as a nationwide firm and have over 1,200 associates firm-wide. So you know, we like to think that we have the depth and resources of a big outfit, a big firm, but really think that we can provide hometown feel because Cindy will attest to when she gives her introduction, she's a product of the local market too. So I think that just speaks volumes to that in general. So I will turn it over to Cindy now for her introduction.
Okay, thank you very much, Stephen. One other thing I wanted to mention about Cherry Becker, like Stephen said, we have a hometown feel, really, because we all live in the community and love our community. The other thing is, even though we are a large firm, we do absolutely everything, being in a small market. So we do have QuickBooks Pro advisors, 3 of those who do QuickBooks consulting and training, actually. And then, of course, we do everything from individuals to businesses, flow through entities, trust, estates, international tax, anything you need, we can do right here. So we're going to start out by talking about PPP loans. I'm sure that many of the people here listening today have taken advantage of that. And so the main thing I want to talk about is to simply help people understand how that's going to affect their taxes. So on the PPP loan, this is a quote from our Treasury Secretary. If the money that's coming is not taxable, you can't double dip. So what does that mean? Basically, it means that you're not going to be able to deduct the expenses, next slide, Stephen, that you, whatever expenses you paid with those funds on your tax return, you are not going to be able to deduct those expenses. This is the IRS Notice 2020-32. If you're interested, you can certainly Google that and get a lot more information. But the bottom line is those expenses are not deductible. South Carolina has already said that they will follow what the IRS is doing. South Carolina is generally pretty good about that. So whatever the IRS decides, South Carolina also follows. So we've got a couple of examples that came out of the notice, and I'm not going to get into them in great detail because I know the first time I saw this, my head was spinning, but the bottom line is, if you go back today and look at your financial statements, your profit and loss, I'm assuming that most of you would still have your loan showing on your balance sheet because it hasn't been forgiven yet. Banks are taking applications now, but I'm not sure that there's been a lot of loans forgiven yet. So you look at your financial statement today, you show a profit of $50,000. I'm just giving that as an example. If you had a $25,000 PPP loan and you use that to pay all the payroll and rent or mortgage payments, all of those things that were permitted, then when you look at your financial statement this afternoon, you've got to add back $25,000. Your income is not 50, it's 75. Okay, so that is going to be a surprise to a lot of people. And so you need to take that into account when you're doing some year-end planning. These examples here talk about when forgiveness occurs, but the bottom line is the expenses are not deductible. So if anybody, I know we said we'll do some questions at the end, but if anybody wants to, I guess they're going to put questions up in the chat box. Is that right, Jim?
Yes, if anyone has questions, just put it in the chat box and I'll try to plug them in here as we go.
Okay, all right. So I'm going to now turn it over to Stephen, who's going to talk about some things that are very important, even though they have a short shelf life right now. There's a possibility that it could be extended. So Stephen, I'm going to let you take it from here.
Yeah, so this is related to employer payroll tax relief. So for employers who have employees and pay wages, there are some things that were passed as part of the CARES Act that relate to that, as well as the FFCRA that we will abbreviate, but it stands for Family First Coronavirus Response Act. So part of what they put in place was this employee retention credit. And we'll get into that, along with some emergency sick leave and some emergency family and medical relief as a result of COVID-19. And then we'll talk briefly just about these deferrals of payroll taxes that the employer can elect to defer, and it's just the Social Security portion, but they can elect to defer that and then pay part of it at a later point in time. So one thing to keep in mind is if you are claiming credits, they will not allow you a deduction. So, you know, credits are always better. You get a dollar for dollar benefit than a deduction. So it still may work out in your favor, regardless of whether you get the deduction. And then for the deferral piece, if you're not actually making the payment, do you get the deduction? And the answer is you don't get the deduction until you actually pay it. So as we move forward, let's talk about the employee retention credit. And it is for qualified employers. They can get a refundable payroll tax credit that's equal to 50% of the wages paid to an individual during that time period. So basically from March 12th through the end of 2020. And the max credit is $5,000, and it's based on $10,000 of qualified wages per employee. One important thing to keep in mind is when you're looking at wages, it's not just the actual salary that you're paying them, but bullet point 3 explains that you can include qualified healthcare costs. So that's important to recognize, because you may have paid an employee, let's say $9,000 during that time period. If you also paid $1,000 of qualified healthcare costs, premiums, things of that sort, well, guess what? You've hit the 10 and you are at the max wages to get the full benefit of the $5,000. So that's important to keep in mind as well. For the employee retention credit, you are not able to claim the credit on wages paid as part of that Families First Coronavirus Response Act, or from the paid FMLA leave or the sick leave. So if you are taking advantage of those type of opportunities, the employer retention credit does not apply. And then the big sticking point is if you received a PPP loan, the retention credit does not apply in your case, and it is not available to government employers. So who's a qualifying employer? So it's any trade or business or nonprofit organization that meets either of the following cases. It was either suspended partially or in full due to government orders, which was limiting business activity. So when we think about restaurants that were mandated to close until they could get that situated out, that was one case. Or you could be in a situation in bullet point 2 where your gross receipts are less than 50% of your gross receipts from the prior year. I had a client that we had a very big discussion about this exact example and whether, you know, the retention credit would apply in their case. The provision ends in the quarter following the quarter that you reach the 80%. So let's say in second quarter of 2020, you dip less than that 50% of the prior year. Your gross receipts are 50% less than they were in 2019. Let's say in third quarter of 2020, well, your receipts are back up. You only had that dip for second quarter. The provision is in place for second and third quarter of 2020 because it ends basically in the fourth quarter. So you've got a 2-quarter time period in 2020 to be able to take advantage of the retention credit. So how does the retention credit get applied? It's assessed at the 941 payroll tax level. So you are able to reduce your payroll tax deposits. For those familiar with making tax deposits for their employees, you remit all your payroll tax deposits, depending on your size at various times, but you claim all those on your 941 and report it all there. So you would apply your retention credit if you qualify against your 941. And it also gets applied after your FMLA leave, your sick pay leave, any R&D credits, which may not apply in your case, but there are other credits that can get assessed on your 941 that come into account before you claim your retention credit. And the retention credit offsets your federal income tax that you're paying for your employees, your Social Security, and your Medicare taxes, both parts, both the employee's part that you're making and the employer's portion. And the good news about the retention credit is it is refundable on the 941. So that is a tremendous help if you're looking to claim these credits, not only to offset your payroll tax deposits, but to actually get some cash back if you need an influx of cash in your business. So a lot of meat there on that one. So we're going to move on with the meat and keep digging into it. Now we're going to look at emergency paid sick leave and FMLA leave. One thing I want to point out about this section is that although this is put in place by Congress and the IRS, the Department of Labor administers and enforces the laws regarding around paid sick leave and FMLA leave. So that's one thing to keep in mind when we start talking about some of these areas. So which employers must comply? If you're a public employer, you've got one employee, guess what? You're covered. You have to follow suit. Private employers with less than 500, and then healthcare providers and emergency responders are exempted because they are considered essential. And then this last bullet point, smallest businesses may be exempt. So let's go ahead and talk about that from the beginning, because I think we have a lot of that may take place here in Aiken. Businesses with fewer than 50 employees can get out of the paid leave exemption, but the officer of the organization has to certify certain things listed on this slide, and that would these things would negatively impact the business and otherwise cause the business to be considered a going concern. If the paid sick leave would otherwise result in financial obligations where you're paying more than your revenues bring in, that could be a triggering event. Or if you're trying to operate and it brings you below minimal capacity, that's another reason that you could exempt out of this. So, certainly, like I said, you want to be able to make sure that you're able to document clearly why you believe you exempt out of this paid leave requirement, because once again, it's administered by the Department of Labor, and I'm not a Department of Labor expert, but they've got certain rules in place to protect employees And certainly we want to make sure that employers are aware of the qualifications that they can have, but to make sure that they are documenting exactly what they need to. So now that we've moved past the exemption part, let's talk about what the leave provisions look like and what they mean. Emergency paid sick leave is for workers who have leave to care for even a child or another family member for someone who's quarantined, self-quarantined, or experiencing symptoms. So that is related specifically to the employee or someone that they are caring for experiencing symptoms. Then you've got the second aspect of it, which is the emergency paid family medical leave. And that is for parents, such as myself, to care for a child whose school or daycare is closed if there's no other child care. So we'll explain that a little bit more in a minute. Once again, just like the retention credit, both the credits related to these are refundable tax credits that are claimed on your 941. So for emergency paid sick leave, it's payable to employees who meet all of these, or not all of them, but meet one or more of these items listed. So whether you were mandated isolation due to COVID, whether you had self-quarantine as a result of a healthcare provider or doctor telling you to quarantine, even if you're caring for an individual described previously, whether it be a family member, a child, it could be a parent or a grandparent that may be living with you. If you are caring for that individual, then you would qualify as having emergency paid sick leave as an employee. And then this catch-all, experiencing another substantially similar condition as specified Department of Health and Human Services. I will always refer back to a doctor on that side of it. So if your employees have had COVID, what does that mean from emergency paid sick leave? How much are you supposed to pay them? So you pay them 10 days pay, because at that point in time, the quarantine was a 2-week period. So they're assuming a 10-day work week or 10-day 2-week work period. And it's based on the grade of regular pay or minimum wage, but not to exceed this $511 per day. So for a 10-day total of $5,110. Once again, this is for the employee. This $511 per day is for the employee who is isolated, quarantined, self-quarantined, or experiencing symptoms. So that is how much the employee would otherwise qualify for paid sick leave if the employee is experiencing symptoms. Then if we look below at bullet point 2, if the employee is caring for others, caring for a child, caring for a relative living with them, 2/3 of the pay is limited for their pay up to $200 a day, or for a total of $2,000. So I think it's very important to know that distinction if you have an employee who has been in that situation, to know what these pays, what the pay rate and pay schedule is for them. And the other biggest bullet point here is the employer cannot require that the employee use other leave first. So as an employer, you cannot mandate that they've got 2 weeks of vacation. They go ahead and take the 2 weeks of vacation to cover their 10-day absence. The emergency paid sick leave comes into play before that. So now let's switch gears to talk about what the mandated paid FMLA leave relates to. So this is a little bit different. This is more along the lines of the traditional 12-week FMLA leave that we typically see when you normally have a birth or your job's protected as a result of certain qualifying events. As long as you've been an employee for 30 days, you are eligible for this mandated paid FMLA leave. If you're unable to work or telework due to a qualifying need, and the qualifying need is caring for a minor child if the school's been closed or child care provider not available due to COVID-19 precautions. So it's a little bit different in that it's not a result of the employee having the virus. They are taking care of somebody else who is has either been closed with schools closed or not having childcare. So the important thing to remember about that is it's still 2/3 of their regular pay. So it goes back to the same example on the previous one where they were caring for other people. It's 2/3 of their pay capped at $200 per day, but they are protected for the remaining 10-week period to get to your ultimate 12-week period under traditional FMLA rules. So once again, that's a little caveat. Schools were closed here in Aiken County from March through May. God bless those parents that had to homeschool their kids. I did not do so well with teaching my child second grade math, but with things, with school being back in session, we're not sure where this may go in the future. And just to throw that caveat out there, all of this is in place through 12/31/2020. What things look like moving forward is yet to be determined. There's a very good possibility that with cases rising and things like that, this may be extended, but I think that is yet to be seen with some additional CARES Act 4, I think, that may potentially come out. Okay, so now we've gone over sick pay, FMLA leave. So what's the credit to tax for employers? What's the tax credit ultimately to them? So for emergency paid sick leave, your tax credit is 100% of wages that you pay. So that $5,110, if that's the max, that is your tax credit, along with Medicare taxes paid on the wages, as well as qualified health plan expenses that were paid during those period of time where they were on leave. For emergency paid FMLA leave, same thing. It's 100% of wages with the payroll, Medicare taxes, and the qualified health plan expenses.
So basically, Stephen, what we're saying is that the government is paying for all of this.
Yes.
Because they're paying the wages as well.
Right.
Because I know in situations we had where people would call us and say they have an employee that's sick, a lot of people didn't realize that in the end, they're not really paying all of that.
Right.
Because
You're
they're
getting it back in the form of a tax credit on your.
So you're going to get it back. But of course, this does have a limited application. But again, we're not sure whether they're going to extend it, which is why we felt like we needed to talk about it.
Right. So same thing with the retention credit. You're going to claim these credits on your 941 and they are refundable once again. So kind of the same thing. There is the ability to use Form 7200 to actually get an advance refund on these. Once again, that's a very situation by situation event that we would need to look at, but there is a possibility of doing that. And as I mentioned earlier, when we started this section, there is no income tax deduction for paid leave amounts where you're getting an offsetting tax credit. So if that situation applies, you're getting tax credits, and on your 941, you're getting money back, but you've also got to remember that you're not deducting those amounts on your P&L. So how does that impact your profit and loss statement when we're looking at year-end planning? Once again, not available to government employers. All right. When we look at the payroll tax deferral, this is another section outlined by the CARES Act where to help with cash flow, the government said we're going to give businesses an opportunity to defer some of the taxes to help with cash flow. Very uncertain times at that point in time, and businesses needed to stay open as best they can. So for any Social Security wages paid, where you've got Social Security tax that would be paid as part of your payroll tax deposits between March 27th and 12/31/2020, you can defer those amounts and you would pay them based on the dates here, 50% due by 12/31/2021. So you're getting very much at minimum a year extension on some of it, on 50% of it, and then potentially up to a 2-year extension for the other 50%. Now, certainly that is an option for employers to take advantage of. It's not mandatory. I have not had any employers that I work with actually utilize this. But what you can certainly do, if you have a third-party provider, you can certainly just tell them that you do not want to pay your 6.2% of wages, or excuse me, your Social Security tax on the wages, and they would not remit those for you. Now, obviously, you want to make sure that you're keeping track of all that so that you can keep straight when you need to make those payments. if you wanted to accelerate them, you decided, you know what, I've got cash flow now, business is doing better, you can go ahead and not wait until 2021 or 2022. You can go ahead and advance that money. You just have to designate what quarter it is when you make that deposit. And then this is just one other thing related to payroll tax, and this is more on the employee side. This was something that President Trump had signed into law by memorandum. And basically it was withholding on the employee's 6.2% Social Security tax, where for the period of time from September 1 through 12/31/2020, the employee could elect to not withhold their 6.2%, so effectively increasing their take-home pay. The problem with that is they would still have to remit the payment by April of 2021. So, you know, they're not getting a full tax savings. They're just deferring when that tax has to be paid. It's optional for the employer. Some employers may have decided to do this. Some employers probably did not. But the big caveat is if you are the employer who did take advantage of this, or let the employees take advantage of it, I should say, the employer is ultimately liable for tax, interest, and penalty amounts not repaid before May of 2021. So big thing to keep in mind if you are an employer who allowed employees to do this. Once again, it's just a deferred tax on the employees' Social Security tax, otherwise would have been paid in through their payroll deduction. So the biggest thing around this is should you implement? I know we're 6 weeks from the end of the year. You know, does this get extended at some point in time? Like I said, there's still, we're not sure how that would work, but just to bring up some of the pros and cons of it, you know, it's a short-term deferral for the employee. It's a little bit extra cash flow. Potential forgiveness of tax that hasn't been addressed yet. Right now it is a deferral, so it will have to be repaid. Is there a possibility that they could come back and say, you know what, we're going to forgive that? I don't know how many are actually participating in this for that to actually make some type of impact. The biggest thing is for the employers. There's a lot of things that the employers would have to do under this cons section that I think may prohibit some involvement in this. And that's just because you'd have to change payroll systems. And if you don't have a sophisticated payroll system, that may be too cumbersome to keep track of all this. And like I said, the biggest issue is the employer is liable for the failure to pay the amounts back over when the employee is supposed to. So, so that's, you know, one of the drawbacks to this. So, okay, everybody take a deep breath because that was a lot of information to go over on payroll. So I promise that was the most meaty section of the presentation. So with that, we'll switch gears a little bit and I'll let Cindy address some additional business deductions that we think employers and businesses need to take advantage of.
Okay, thanks, Stephen. You know, on that employee tax deferral, we definitely did not recommend that anyone do that. We did have clients call and say, oh, a lot of times the employees know more about some of this stuff than we do. You know, they're all asking this question, but we just basically said right off the bat, no, we don't think it's a good idea, because a lot of those people, they're wanting that deferral, but then they're going to have to pay it back later. And then that's going to be even a bigger problem probably. So
let me pause you right there real quick. I forgot to mention one thing. If you are a self-employed person and you have no payroll, do you qualify for any of the credits? And the answer is yes. The self-employment, if you're just a Schedule C and it's solely you, you do get to take advantage of those, and it's based off your net self-employment earnings that are generated on your Schedule C. And then you basically have to divide it by 260 to get an average daily rate that you can ultimately claim as a tax credit. So there's a little bit more calculation as it comes to a self-employed individual, but you do get to take advantage of some of this as long as you meet all the other requirements outlined by the credits for the employers as well. So I did want to mention that.
also, if you feel like you may have paid some employees that had COVID and you did the emergency paid sick leave and didn't really realize you could take advantage of those credits, you can go back and amend your payroll tax returns at this point in time if you in fact did have some employees and you just went ahead and paid them because you thought it was the right thing to do, and not realizing you could have taken a credit on your payroll tax return for that. So if you did that, you definitely need to talk to your payroll provider or whoever handles your payroll to get those credits and amend those payroll tax returns. Okay, so now we're going to talk about business deductions. We're going to start off right off the bat with, and of course, here's the accountant coming out, NOLs. Everybody's like, what's an NOL? Okay, net operating losses. The Tax Cuts and Jobs Act that was passed in December of 17, we were talking about that before we started. You know, that was a large act that really did a lot of different things. It reduced the income tax rates, it doubled the standard deduction, it changed itemized deductions greatly, where you couldn't deduct certain things, state taxes were capped at $10,000, et cetera. The other thing that it did was it eliminated the ability to take a loss from your business and carry it back. And so now, a couple of years later, we have COVID, so they revised the carryback rules. So, and of course, I would expect that most of you operate in flow-through entities, a partnership, a Schedule C, where it's just on your personal return, or an S corporation, where ultimately those losses flow down to your personal return. If you had a loss from 2018 or 2019, you can now go back and carry those losses back 5 years. If you want to do it in a very efficient manner, you have to get it done by the end of December. And the forms that we've referenced here, you can actually fax those forms and supposedly they will be expedited. And it's a way of getting some cash back on those losses. Previously, you would have had to have carried those forward. Obviously, you need an accountant to do this because these are really complicated to do. But it is a good way to generate some cash. So if you've got losses that you've already experienced, take advantage of that. And in 2020, if you have a loss, then you can also carry that back as soon as you're able to file your tax return and get it filed. You'd be able to carry back that loss. And so so we want to talk about now some things that you might want to do. Do you want to create a larger loss in 2020 so that you can carry it back and get some of that money back that you paid taxes on 5 years ago when things were really going strong? Okay. Next slide. One thing that's been around for many years now is this de minimis expensing. And you know, if you're using an accountant, they know this, but the bottom line is if you buy any type of equipment that costs $2,500 or less, everybody here is going to be a taxpayer without an applicable financial statement. $2,500 is the limit. So if you buy a computer that costs $1,200, you can just immediately expense that. It's not depreciation, it's just going ahead and expensing it. And so a lot of times people will capitalize every little thing they have. They bought a $400 computer, they bought a $400 printer. All those things can immediately be expensed, and that can increase the loss or decrease your income. Okay, now cost, next slide, cost recovery. You know, these are all things, the first two especially, that you've probably heard of. 100% bonus depreciation. If you're in a income situation right now and you bought some assets, maybe you're thinking about buying something before the end of the year, regardless of whether you finance it or however you end up purchasing it, you can take 100% bonus depreciation, which means you write off the entire $80,000 piece of equipment or whatever it is you're buying in this year. The good thing about bonus depreciation is that you don't have to show income. You can already be in a loss position and you can create an even bigger loss. So let's say you wanted to take advantage of being able to carry the loss back to get some cash, then it might make sense to take advantage of doing the 100% bonus depreciation. Now, that being said, you know, if you have an accountant, I'm assuming everyone does, they're going to be looking at these things and hopefully having a conversation with you about what's the best way to go for you, because what do you think 2021 is going to look like? Okay. So 179, I'm sure everybody's heard about 179. They love 179. 179 is, you can also expense. The difference is though, you have to have income before you're allowed to do section 179 expensing. You can expense up to $1,040,000 worth of equipment in this way. So more people probably take advantage of the bonus depreciation. The only disadvantage of bonus depreciation is that South Carolina does not allow it, whereas South Carolina does allow section 179. So that impacts your South Carolina return. This last slide, the last caveat there, qualified improvement property. I don't want to get into the weeds on this one, but basically also as part of the Tax Cuts and Jobs Act, there was a glitch in a definition of qualified improvement property and how you could depreciate it. First of all, I know that y'all probably don't know what that is. It is basically interior improvements that you make that are not related to the integrity of the building. So if you did an upfit for a lease that you currently have, or you own a building and you did an upfit to the interior part of the building, the glitch in the law said that that was 39-year property and straight line depreciation, which means it really drags your depreciation out a long time. Now they have said that that qualifies as 15-year life. There's been a technical correction, and that means if it's 15-year life, that it does qualify for bonus depreciation. The way that you make those changes is a little bit complicated. You can do a catch-up, or you can actually go back and amend returns. There's a couple of different ways to do it. We're not going to get into that. But just if any of you have had qualified improvement property additions in 18 or 19, that's something you want to go back and look at. Okay, next slide. All right, so, you know, I don't know exactly what our audience is, but the thing that's complicating about this year is we have a new president. There's going to be probably tax law changes. We're going to talk about that at the end. But depending upon where you are at this point in time, do you want more income in 2020 or do you want less income? Some people want to show more of a loss because they want to carry it back and get some cash. Other people think that tax rates are going up, so they therefore want to do something different. So each person's going to have to really sit back in a dark room and think about where they are on this. If you've got, if you're on accrual basis, you can see the suggestions here. Obviously look at your accounts receivable and figure out, okay, which ones are really worthless? Do I think I'm going to get this? If you're cash basis, that means you're going to go ahead and pay some expenses either by a check or a credit card before year end so that you get the deduction. Perhaps you want to do some bonuses to the owners. And of course, finally, retirement plans. They're the greatest thing ever written in terms of tax savings and planning for your own future. We are going to talk about retirement plans a little bit more on another slide. And then finally, we've talked about expenses now, deferring your income. Many times I'll have, typically at this time of year, Stephen and I look at our client list, we reach out, we say, what kind of a year are you having? Do you need us to look at your tax planning? And one of the big things that's very easy to do, and many times I say, please stop billing. So in other words, you're having a great year. You can go ahead and do the work, but just don't do an invoice because they're not going to pay you if you don't bill them. A very simple technique to do. On the other side of the coin, though, let's say you're in a position where you really want to have more income in 2020, then of course you're going to bill as soon as possible, and then you're going to get your customers, plead with them to give you the cash before the end of the year if you're a cash basis taxpayer. Elect installment sales, of course, if you're trying to defer gains, in many cases, if you're selling something, you would try to negotiate and get the buyer to do an installment sale. Also, maximize Section 1231 losses. Those are just assets inside of your business that you may have a loss on. It could be a piece of equipment, something like that, where you already know that it's worthless and you want to go ahead and just write that off and sell those equipment. So, okay, now we're going to talk about a few things. The first one, qualified health reimbursement arrangements. This has very, very limited application for most people. What that is you have a plan that has to be a written document where you say you're going to reimburse each employee's medical expenses, and maybe you put a cap on it of $2,000. This only works in situations where you don't have a lot of employees, obviously, because you cannot discriminate. It would have to be available to everyone. But let's say you're a small employer and most of the people that work for you are family members. Well, then you get to deduct, you're basically paying some out-of-pocket medical costs for your family, and you're getting to deduct it in your business. Health insurance premiums for self-employed, of course, hopefully you're all aware that those are deductible. That includes long-term care premiums, as well as if there was someone who was actually on Medicare and they still had a business and they were still working, it includes your Medicare premiums that are taken out of your Social Security check. HSA accounts, we're going to talk about those a little bit more on the next slide because we really feel like that's something that's part of our future. As I said, retirement savings plans, this is the greatest thing going. You're putting money aside for yourself, you're getting a tax deduction. The different plans we have listed there, the simple plan is one you probably have heard of quite a bit because it is very inexpensive to operate and to start. And it allows you defer wages, and you don't have to pay anything for your employees unless they do the same. 401ks are a little bit more expensive, but if you wanted to literally put in $40,000 or $50,000 into retirement every year, you would need to choose the 401k option, which of course is a type of profit sharing plan. And also don't forget that if you set up a retirement plan, there is a credit of up to 50% of what you spend. The credit can be up to $500. Okay. Health savings accounts. Reason why we want to kind of talk about this is because this is the way the world is going, right? Healthcare costs are out of control. And even within our own company, we just made our health insurance elections, had to do it by the 15th of November. Our company no longer offers anything except a high deductible plan. As part of that, then, of course, you are able to put in money into a health savings account, basically equal to what that deductible is. While the funds are in the health savings account, you're getting tax-free earnings in that fund. And the employee, if you establish such a plan in your business, if you provide health insurance, they're getting a deduction for the contributions that they make. If you are self-employed and you're getting insurance on your own, and perhaps you don't even provide it for your employees, this is also something you can take advantage of. The other thing that many people don't realize is that on the health savings accounts, you don't have to get reimbursed in the year that you have the expenses. As you can see, there's no time limit. So 10 years from now, you could leave the money in there and let's just say you keep funding the health savings account and every year you're putting in the maximum. 10 years from now, if you still have those receipts, you can then get reimbursed. Why would you want to do that? Because all of that, you can actually invest a health savings account in an investment that has more than a money market account. In other words, they have investment choices. And so you can actually have this tax-free growth in there, and then you can later get that money out, perhaps when you're retired, and it's still, all that is tax-free, and it has been growing all of that time tax-free. And health savings funds can also be used to pay for long-term care insurance premiums. You could do that now, or you could delay the payment till later. So we feel like that's going to be the way of the future because of the out of control healthcare premiums that we see everywhere. Okay, Stephen, I'm going to make him talk about 199A. A lot of you probably have heard that code section thrown around, and we're not going to get into the weeds on this one either, but we do want to at least mention it. So Stephen, I'm going to let you take it from here.
Yeah, just a refresher, this 199A deduction for qualified business income is essentially a 20% deduction potentially on qualified business income. Now, just as a refresher, you have to be separated out into regular trader business or a specialty service trader business. Accountants, lawyers, professional firms like that fall into the specified service trader business, so they have some separate limitations. But the biggest thing that we want to point out around this is this income threshold. So the new income threshold for married filing joint couples is $326,000. If it's less than that, you're going to get a flat 20%. Once you start getting into the phase out range, it'll obviously get phased down. Once you hit over 426.6, you're going to have some other adjustments that come into play and some other rules depending on whether you are regular operating business or considered a specified service trader business. So the biggest thing around this with tax planning is you kind of want to manage your income as you're hovering around these thresholds. If you're below the thresholds, great. Maybe you still want to manage your income expenses, but not necessarily as a result of the QBI deduction. But if you're in that phase out or getting ready to top out, does it make sense to do some of the things that we've kind of already outlined with either bonus depreciation or deferring income, accelerating expenses, things like that? Another caveat would be consider if married filing separate gives a better result. And I would caution this to tax rates are different when you are married filing separate versus married filing joint. But in the event that one spouse has QBI income, if they otherwise file separate and they end up becoming, the threshold is lower for married filing separate, it's effectively half of the numbers listed here. So if one spouse has QBI income and it's less than the threshold for married filing separate, does it make sense then to potentially look at that? I would certainly say that's not a general rule of thumb, married filing separate to be better, but something to look at in regards to your QBI deduction. The other big thing just about this is a 250-hour rental real estate contemporaneous records. If you are dealing rental real estate, you have to have 250 hours per IRS regulations to be able to qualify that rental property as a qualified business. So if you've got one rental house and you're not spending a lot, it would be hard to spend 250 hours on one rental property. Does it make sense to start looking at multiple rental properties if you have those and different aggregation rules? So those are some things that you at least need to think about and bring up with your accountant in regards to the QBI deduction. So nothing structurally has changed with this law, just kind of some pointers around planning and looking at year-end income levels. I'm not sure if anyone is aware of the opportunity zones, but this is certainly something you could take advantage of if you have generated capital gains. So if a taxpayer has a capital gain, whether that be from the sale of property within your business, if it's significant enough to make the opportunity zone investment worth it, if it's even capital gains from your stock portfolio, those certainly qualify for investment in opportunity zone fund. And essentially what you are doing is you are taking your gain and you are investing that money into an opportunity zone. So an opportunity zone is something that was set up and established as part of the TCJA to help fund projects in underserved areas to create growth and capital investment to kind of help better those areas that were underserved. So the opportunity zones on its face, I think, are great for driving growth in business and income in those areas. But also from a tax perspective, when you're deferring that income, if you invest your funds and you hold it for 10 years, you pay zero tax on any capital gains associated with your investment. So if you invested $100,000 in an opportunity zone fund, you held it for 10 years, you sold that investment for $200,000, that $100,000 growth would be, there would be no tax on that capital gain. So there are certainly some advantages to take place with that. And, the business can do that. The individual can do that. Once again, it just has to be qualified capital gains. And certainly, once again, that may not fit the mold for everybody on the conversation, but certainly still something to think about. If you've got significant gains, do the gains qualify? Does it make sense? What are the exact rules about investing in an opportunity zone fund, which would be a partnership essentially established? So you would be investing your money in that. So, there's some deeper discussions we can certainly have as to whether that makes sense for certain individuals, but certainly a great opportunity to defer some income and possibly see some deferral of gains, and then potentially, the growth in the investment could be tax-free. So that's some good things to think about. Cindy's gonna talk about some retirement changes. She's my retirement guru. I go to her for everything retirement. So I will let her talk about some changes to retirement as a result of the Secure Act.
Thanks, Stephen. Looks like we're 10 minutes left, so I'm going to try to speed this up a little bit. One thing that I have not heard as many people talking about this. This is a way for you to get some cash in your business. If you want to withdraw $100,000 from your IRA, Stephen, go ahead and click on, you can do that before the end of 2020. You will not pay a 10% penalty. You have 3 years to repay it or to take it into taxable income. And these are the qualifications for you to be able to do that. So why would you want to do this? You need money and you need cash in your business. You don't want to get a loan. You feel like you need some cash. This is a quick and dirty way to get it. It's pretty easy to qualify. My son, who is still a dependent, unfortunately, we hope that's not going to keep going on. But anyway, he had COVID. So I could literally do this and I wouldn't necessarily have to put it in a business. I could just take some money out of my IRA and do with it whatever I wanted to. But it's certainly applicable for businesses if you needed some cash and you felt like you wanted to do that before the end of the year because of the uncertainty with 2021. Okay, next slide. Not going to talk a whole lot about this. I'm talking some about these issues here with IRAs, even though it's not necessarily applicable to a business because it has to comes into play on your individual tax planning. You know, they suspended the requirement that people that were taking a minimum required distribution take those, but it's still a good idea to at least look at that, because you can still make qualified charitable distributions from that IRA. If you are over 70 and a half, then you would still want to consider doing that, because you probably are taking the standard deduction and not getting a benefit from your any charitable contributions. Okay, so more IRA. Not going to talk about everything on here because we're running out of time. One thing I do want to point out is converting a traditional IRA to a Roth IRA this year. Why would you want to do that? If you have a business and it's a flow-through entity and you are losing money, let's say you typically were in a 24% bracket. All of a sudden you find yourself in a 12% bracket. That's married filing jointly up to $80,250 taxable income. Would it make sense to take some money from your IRA and go ahead and convert that to a Roth in 2020? Because this may be hopefully the last time you're going to be in a low bracket. We hope things are going to turn around. But if you have a window of opportunity to convert that money from a traditional IRA at a 12% tax rate, you convert it to a Roth IRA, and I'm sure everybody knows the Roth IRA can grow tax-free. You never touch it because you really don't need that money. That would be the first caveat. And you live 35 more years. Then when you pass away, your children just inherited a hopefully large account that is completely tax-free to them. So that's another thing to consider at the end of 2020 if you do think your income is a lot lower than it typically has been. Okay. We've got just a few minutes left, and we do need to leave time for questions. So Stephen, I think we need to limit what we say about Biden's tax proposals, because we only have 6 minutes and we do want to answer questions. Jim, do we have any questions out there that we need to answer?
There's nothing in the chat right now, so.
Okay. All right, so go ahead, Stephen, knowing that we only have 6 minutes to just go over these very quickly. Just wanted to give you a flavor of what 2021 and beyond may look like, because as we said, a lot of people are expecting tax rate increases. Okay, go Stephen.
Right, and as we're still waiting for recounts and officials to certify everything in their states, certainly the biggest question we have been asked by our clients with President-elect Biden is what does the future look like? And man, I wish I had a crystal ball, because I think I can make a lot of money if I did. But we do know that based on his proposals that he's put on his campaign website, that these are just a couple of things that he would take a look at. I'm sure everyone's had kind of an opportunity to read some of this. His plan would raise tax revenue by $3.375 trillion over the next decade, while spending $5.37 trillion dollars. So I think the more important things that we wanted to point out, I've highlighted kind of in red. The first one talks about this little donut hole that's going to be created. Social Security is taxed up to $137,700 of wages or self-employment earnings. Once you hit that threshold, you do not pay any more Social Security tax, and that has typically been the case, except for now. President-elect Biden has proposed or mentioned that once you reach $400,000, you would go back to paying 6.2% on your wages. So you'd have that little, what I refer to as a donut hole, created between the 137.7 for 2020 and the 400,000 potentially, if that gets put in place. Second bullet point is he's wanting to make the top rate back to 39.6, would be pre-TCJA, Tax Cuts and Jobs Act level. One more big caveat would be long-term capital gains and qualified dividends would go to the ordinary tax rate of 39.6% as opposed to the 20% rate that they are currently at now, and that's for income over $1 million. Since we talked about itemized deductions a little bit beforehand, they would restore the piece limitation, where basically once you got higher in your income, you would start having your itemized deductions phased out. So you may have total itemized deductions of $50,000, but because you make money over the proposed $400,000 threshold, that $50,000 might actually be phased out to be, let's say, $35,000. I'm just throwing numbers out there, but that's an example of what the piece limitation would actually do. And then the biggest caveat would be this qualified business income deduction, the 199A that I spoke about earlier. The cap, top end cap is 426.6 now for 2020, potentially with $400,000 more of income that would eliminate for anyone over that threshold to claim that deduction. Just a couple of things. Child independent tax care credit, he would raise the maximum amount of expenses from $3,000 to $8,000, which would increase the credit that people could claim. He's wanting to potentially increase the child tax credit for children that are 17 and under, for them to get an extra. Right now it's $2,000. They get an extra $1,000 for $3,000 for that. And then the very last part, as part of the TCJA, the estate gift and tax levels were up to 11 million and some change. Very big to have a taxable estate or to even use all of your gift tax exemption as a result of those high levels. He's proposing to restore those back to 2009 levels, which would be roughly $5 million. That would be indexed for inflation and all the stuff that the IRS likes to adjust for inflation. You know, some of the business tax changes, he would, you know, these are C Corps specifically, not any pass-through entities, would raise the rate from 21% to 28%. And then, you know, a lot of these probably are not going to apply in this situation. I know GILTI isn't going to apply more or less in this situation. So, you know, ultimately, you know, we're not sure exactly where we're headed moving forward, you know, depending upon the Senate races that are still to be determined in Georgia can swing the balance of power. Certainly, you know, when you have, you know, the government set up the way it is, you know, if the Senate's controlled by a particular party, that may help either pass legislation or slow legislation down. So, you know, I think certainly there's no one size fits all when it comes to tax planning with everything that we've talked about. And does it make sense to accelerate income for your business? Does it make sense to defer deductions until 2021, accelerate that income into 2020, defer into 2021? You know, I think it's certainly a case-by-case situation that you would need to discuss with your accountant, or certainly we don't mind taking questions in regards to that. So Cindy, do you have anything else you want to add?
I just wanted to add one small thing. Applaud everybody who came today, because I think that so many business owners don't even understand their financial statements and certainly are not that involved. They kind of just depend on the accountant. It's very important for everyone to at least be able to read their financial statement. And I had a situation just this last year, and I've had many of them occur over the years, where someone said, oh, this particular one, he bought a business for his daughter. He owned the business, so he got the losses, which he liked. He didn't care if it lost money because he bought the business for his daughter. Anyway, this year, guess what? The business made money. And we normally were not that involved because it was a very small business and she didn't need any help. Basically, came time to do his tax return, and to do that little small business return, she had an income and he was at the top rate. And he goes, how in the world could she have income? You know, well, she does her own QuickBooks. She never looked at her financial statements. So hopefully each and every one of you do look at your financial statements every now and then. And the bottom line is you have a good accountant who can help guide you through that. You don't have to be an accountant totally to be able to understand things. But I wanted to ask one final question. Does anybody know who Walt Disney, well, of course, everybody knows who Walt Disney is. Stephen, do you know who Roy Disney is?
Roy Disney. He's somehow related to Walt. That's all I can guess.
All right. Well, just wanted to let you know that Roy Disney was Walt's brother. And guess what? He was an accountant. And had it not been for Roy, Walt would have not been able to achieve the success that he had, because Walt had the other side of the brain and Roy had a different side of the brain. And together they were highly successful. So just partner with people that can help you magnify your strengths and help you live through your weaknesses.